Welcome to The Economist in Your Ear podcast. With the price of gold hitting these record highs and, well, global finance seemingly shifting east, is Hong Kong really poised to seize this new golden age in precious metals? Or is this, just impressive-sounding infrastructure without much real substance behind it? That's really the strategic puzzle we want to explore today. Hong Kong's put forward this extremely aggressive new policy goal. They want to develop the city as the crucial international channel for the gold trade. And they're explicitly trying to leverage mainland China's huge position, right? World's largest producer and consumer. So we're going to unpack the sheer ambition here and also look at the, frankly, massive hurdles in the way.
Yeah, and what's fascinating and gives this whole effort its immediacy is the market environment itself. It's incredible. Gold has been, well, a powerhouse. We've seen explosive gains. We saw that recent record peak. Okay, maybe an outlier figure. Over $4,380 an ounce, maybe reflecting some extreme volatility or local trading. But the more telling thing, perhaps, is the whiplash. That steep 5.3% drop in one day, October 21st, steepest in 5 years.
That kind of dramatic swing really shows the underlying tension in the market, doesn't it?
Exactly. Profound tension. And this high volatility, plus the fact that central banks everywhere are snapping up gold, accumulating it at historic rates, often seen as a strategic move away from, U.S. dollar dominance, it makes this a pretty opportune moment for a major new hub to try and, anchor itself. Hong Kong's essentially betting that global anxiety plus a desire for non-USD settlement will drive business its way.
Okay, let's look at the infrastructure side then, because that's where the ambition really takes shape. This isn't just tweaking things. This is a radical expansion we're talking about. Currently, Hong Kong's gold storage capacity, mostly at the airport depository, it's quite modest, maybe 150 tons, something like that. The new mandate coming from the Financial Services and Treasury Bureau and the Chief Executive's office is to blow that up to a staggering 2,000 tons within 3 years.
Yeah, 2,000. That sevenfold expansion is just massive. It sends a very clear global message. And it also doubles an earlier target they had, which was already ambitious at 1,000 tons. And just to put that 2,000-ton figure in perspective for everyone, it significantly surpasses Singapore's main dedicated facility, the Reserve. That holds about 500 tons. So Hong Kong is effectively shouting, we are building the capacity needed for geopolitical diversification.
But, okay, London and New York still completely dominate setting the global gold price. So is just being the plumbing, is that enough? Is sheer capacity alone really a competitive edge to justify this huge investment?
That's the absolute critical insight here. Hong Kong knows it can't set the price. Its strategic mechanism, its whole play, is to be the indispensable Asia RMB bridge. They're building the infrastructure not to discover the price, no, but to facilitate the flow, especially a flow coming out of or connected to mainland China. And the key component, the linchpin really, is the Shanghai Gold Exchange, the SGE. That's the mainland's main highly regulated gold market. The SGE opened its first offshore vault right there in Hong Kong back in June. And crucially, with that launch, they introduced 2 brand new RMB-denominated contracts, specifically designed for global investors.
Okay, so what's the actual practical advantage of having that SGE vault there for, say, a global fund manager?
Well, it lets investors hold and settle metal in Hong Kong using Chinese currency, the RMB, without having to navigate all the significant logistical hurdles, the capital controls, the regulatory friction of operating directly onshore in mainland China. It's meant to be a clean entry point. If you want exposure to the huge Chinese market or you want to settle in RMB, this is designed to be your most efficient, least bureaucratic pathway now.
And we're already seeing some big global players responding, which suggests maybe the industry buy-in is happening now, not just hypothetically down the road. MKS PMP, for instance. Huge global gold trader and refiner, basically a major flow provider. They set up their regional HQ in Hong Kong this year, and they specifically pointed to the government's initiative as the main attraction.
Exactly. That shows the new pipes are already attracting, or at least are perceived to be attracting, high-volume users. It's a significant signal.
Right. And beyond these new pipes, Hong Kong has always had these strong, sort of established structural advantages, hasn't it? Things that appeal to global capital, especially for those looking to diversify away from the dollar. You've got the perfect Asian time zone, the familiarity of the British-style common law system, and its status as a completely free port. No foreign exchange controls on moving precious metals in or out. Yeah.
And if you connect that back to the bigger strategic picture, it reinforces the goal. Hong Kong isn't really aiming for a zero-sum fight with, say, Singapore. It's positioning itself to offer something complementary, something necessary. The end game looks like being universally recognized as the primary RMB-facing node in the global gold system, sitting alongside that existing power trio, London, New York, and Singapore.
Okay, complementary. So if they're complementing Singapore, they must be offering something distinct because Singapore has really deep established logistics, right?
Yeah.
So what's the infrastructure stack, as you might call it, that Hong Kong absolutely needs to nail to win that complementary role?
It's basically threefold, and yeah, execution has to be pretty much flawless. First, yes, the vault capacity itself, that headline 2,000-ton figure, that's table stakes now. Second, they need a really robust central clearing mechanism. This is crucial for efficiently netting and settling trades between multiple banks, refiners, investors. It drastically cuts down operational friction and costs. And third, they need adjacent, sort of future-facing products, specifically tokenized gold. This is arguably where Hong Kong tries to leapfrog some of Singapore's decades of built-up physical logistics depth.
Tokenized gold. Can you explain that quickly for listeners who might not be familiar? How does that help them leapfrog?
Sure. Tokenization is basically creating a digital representation, a digital token of ownership of physical gold, usually on a blockchain or some kind of distributed ledger. The key advantages are speed and cost. Instead of physically moving a heavy insured gold bar from Vault A to Vault B, which is complex, slow, and expensive, you just move the digital token representing that ownership instantly, globally. For a hub like Hong Kong, needing to attract high-frequency traders, massive institutional volume, it potentially minimizes the importance of having the absolute deepest, oldest physical warehousing network, which is where Singapore currently has a big advantage. So tokenization becomes almost a strategic necessity for them, not just a nice-to-have add-on.
Ah, okay.
Yeah.
That makes the competitive dynamic much clearer. They can't perhaps beat Singapore on decades of physical depth, so they have to try and win on financial efficiency, RMB access, and this kind of digital innovation.
Yeah.
Makes sense. But let's turn to the necessary skepticism. Capacity announcements are one thing. Utilization is the real test, surely. What stands out to you as the most critical proving ground here? Where could this fall down?
Absolutely. Utilization is everything. Throughput needs to massively outweigh the headlines. Building a huge, mostly empty vault is, well, it's a failure. Simple as that. Success means regular, active inflows and outflows, high usage of those new RMB contracts we talked about, and, critically for traders, tight bid-ask spreads during Asian trading hours. If the spreads are too wide, if it's too expensive to trade in Hong Kong compared to London or New York even during the Asian afternoon, traders just won't bother. They'll stick with what they know. Hong Kong has to become truly indispensable for Asia-hour liquidity. That's the goal. But, beyond just utilization numbers, probably the most critical industry worry, the one participants keep mentioning, it centers around how seamless the policy coordination is between Hong Kong and mainland regulators. This could be the operational Achilles heel.
Okay, policy coordination. How does that specific regulatory friction actually play out? What does it mean in a real-world trading scenario?
Well, it determines how smoothly metal can actually move, even if just virtually on the books. Between the SGE's onshore system, those highly controlled positions within mainland China, and these newly established offshore positions in Hong Kong. If that coordination is clunky, if policies shift unpredictably, or if the red tape involved in moving between the two systems is just too thick, it basically negates the whole advantage of those offshore RMB contracts. They become administrative burdens. And those firms like MKS, PMP, they might just pull back, seeing Hong Kong not as an efficient bridge, but more like a ghost town for RMB gold settlement.
That does sound like a potentially serious systemic risk baked in there.
Yeah.
And apart from the regulatory synchronization, what about the really practical physical stuff? Singapore has been doing this for decades.
They absolutely have deep logistics, no question. And sources point to two pretty significant practical challenges Hong Kong still faces on the ground. First, there seems to be a real shortage of specialized labor. We're talking about people needed for high-security vault operations, but also, very importantly, for the complex process of assaying.
Assaying, that's the meticulous testing of the gold bar's purity, for those unfamiliar.
Correct. It's absolutely essential for maintaining trust in the whole system. If you can't quickly and reliably verify the purity of the gold moving through your vaults, Trust just breaks down fast. And secondly, despite that huge 2,000-ton plan, Hong Kong still has, right now, more limited physical warehousing capacity around the main facility compared to what Singapore has built up over many years. They really have to play catch-up on the surrounding physical logistics network and also on finding and training that highly specialized workforce needed to actually service this massive new hub.
Okay, so we've covered quite a spectrum here, haven't we? From that visionary, almost mind-boggling 2,000-ton target, down to the gritty reality of finding enough skilled people who can accurately assay gold bars. Hong Kong's ambition is undeniable. It's enormous. And it is backed by concrete steps. That SGE offshore vault is operational. They have the audacious storage target on the books. The central clearing mechanism is reportedly in development. They seem deadly serious about boosting their role as a major precious metals hub.
Yeah, and what's really fascinating here, I think, is the potential long-term impact on global finance, almost regardless of where gold prices are week to week. If, and it's still an if, but if Hong Kong can sustain this high level of policy support from Beijing and Hong Kong authorities, and crucially, if they can successfully navigate that really tricky regulatory coordination with the SGE, it genuinely creates a vital institutional-grade financial mechanism, a new way to diversify global precious metal trade. It offers a clear, secure anchor for trade outside the traditional Western financial centers, moving things much more firmly towards an RMB sphere of influence.
Right. We talked earlier about how that recent steep gold drop was maybe fueled by short-term hopes around easing trade tensions. But here's maybe the provocative final thought for you, the listener, to mull over. If this new enormous 2,000-ton vault capacity does get fully utilized, and maybe gets filled primarily by central banks looking for that long-term diversification away from the US dollar, does Hong Kong's success then ultimately signal a deep, maybe even irreversible geopolitical shift in global finance, a shift that matters far more than any short-term trade headline? Or alternatively, will those logistical hurdles, the talent gaps, and especially that critical regulatory coordination prove just too great, leaving this impressive infrastructure stack tragically underused? Thanks for listening. Follow us for daily insights into world affairs, and don't forget to like, comment, and share.